UK house prices just dropped for the second month in a row. This is the biggest fall we've seen in a year. Now, is this just a blip or the start of something bigger? Now, in this video, we're going to break down what's happening in the UK property market right now, including house prices, inflation, interest rates, buyer demand, and affordability. There's a lot to unpack. So let's dive straight in. Let's start with some good news for a change. The Bank of England dropped their base rate slightly from 4.75% to 4.5% back in February. That's not a huge shift, but it is a shift that's welcome for a lot of borrowers in the country. And inflation is heading in the right direction too. It dipped to 2.8% back in February. Now, it's still above the Bank of England's target rate of 2%, but certainly better than what we were last year. And housing-related inflation, so things like owner-occupier costs, also dipped to 7.5% in the same month. Now, this is going to be a relief to a lot of homeowners across the country. That said, the economy is still on shaky ground. In fact, GDP dropped by 0.1%. It's not massive, but it is signs that things aren't exactly charging ahead either. Now on to house prices. The average UK house price was just over £260,000. That's 7 times the UK average salary. Now this shows that affordability continues to be a big issue. And when it comes to Northern Ireland, this is the area that has grown year on year. And other areas in the UK is kind of a mixed bag. Sales volumes are up over 20% year on year. But let's be honest, these are lagging stats because they reflect completions, not new activity. However, when we look at new buyer registration per branch, we can see that actually dropped in February at 81% on average per branch compared to 87% in January. Now, let's talk about what just happened in March. We've just seen the sharpest monthly drop in house price in the UK for over a year. In fact, Halifax says that the average house price fell by 0.5% in March. That's bringing their average price to just over £296,000. This is actually the second month in a row that prices have dropped. February's figure from Halifax was actually revised to a 0.2% dip. Let's put this into context. This is no way a crash. It's more of a correction and a call off after a very busy January. Why? Well, a lot of buyers wanted to rush to beat the stamp duty deadline of the 1st of April. Remember, those temporary stamp duty cuts in England and Northern Ireland are now over. This means that first-time buyers now pay tax on properties over £300,000, down from £425,000. In London, that pretty much means on any property you're now paying tax. And that general zero tax threshold dropped from £250,000 down to £125,000. Now that rush spiked completions. In fact, if we look at March, it's probably one of the busiest months for completions on record. But now that the flurry is over, demand is easing back and so are prices. Now, Amanda Bryden at Halifax basically said people rushed to beat the deadline and now we're back to normal, and that's showing in numbers. Still, many analysts are optimistic that prices could pick back up later in the year, especially if interest rates keep dropping and mortgage deals stay competitive. So again, this drop is most likely to be a post-stamp duty hangover and not the start of any major correction. Going back to our February stats, there is a bright side if you're a seller. Now, what we can see is that those viewings have picked up, especially as we kick into springtime. It's now 2.7 per property. When it comes to mortgages, well, lending has also increased. We saw an increase in gross mortgage advances and commitments on the last quarter of 2024. So there is some movement, but let's be real, affordability is still rough. Between February and March, 32% of adults said that they were struggling to pay their rent or their mortgage. So whilst there's still movement, there's still challenges there. On the arrears side, there's not that much change. They remained pretty stable throughout 2024. On the possession side, well, that did drop ever so slightly. So that is a positive sign, right? Looking at supply, new listings are up slightly. In fact, 10 homes per branch compared to 10.5 in January, but overall stock levels actually dropped a bit, down to an average of 41 properties per branch. And market appraisals, which gives us a glimpse of future listings, well, they dipped ever so slightly too, but that's normal for this time of the year. Sales agreed remained steady from January to February. Not much change month to month, but still stronger than where we were at this point last few years. However, only 9% of homes hit their asking price in February, down from 12% in January, which tells us that pricing power is slipping a bit. Sellers are having to be more realistic. And finally, the time from offer accept to exchange is still dragging on. In fact, some agents are reporting 17 weeks or more. Now that's still high, but there are signs that it is trending down slowly. So where does that leave us? Well, we've got softening interest rates, we've got inflation dipping a little bit, and some early spring activity picking up, but affordability is still tight, buyer demand is still a little patchy, and stock levels aren't exactly booming. This isn't a crash, just a correction in the UK housing market. If you're a buyer right now in the UK property market, there may be some room for negotiation, but the window of opportunity may be closing. And if you're a seller, price realistically and be prepared to wait.